Welcome back to Trade 360. I'm Diane King Hall. Time now for the big three stocks, three charts, three trades. Rick Ducat will take us through the charts. And here to take us through the trades on his list is Don Kaufman, co-founder of Theo Trade. It's great to see both of you. Don, why don't we start out with the first pick on your list, first ticker TLT, the 20-year Treasury Bond ETF. So what's your view here?
Yeah, well, to begin with, come on, the bond market right now, this is in the hearts and minds of every trader, of course, with today's FOMC announcement. But, this particular trade that I'm bringing up right now, it's less about the FOMC, which is, critically important for today. But my trade is much more about spending and the spending bill that's effectively going to be passed, possibly not passed. They're not going to make the July 4th deadline. Things are going to get interesting. Nevertheless, okay, I'm going to get big and I'm going to get bearish inside of the TLT going out to the July 18th expiration, because I think that is right in and around the time that the big, beautiful bill may actually see the light of day. I'm going to be buying the 86 puts, selling the 82 puts for about $1 debit. This actually looks for the TLT to effectively break into new and recent lows, 83 being the low. And as we'll see here momentarily, again, breaking through those lows speaks of bond vigilantes everywhere.
Okay, I love the alliteration there, Don. All right, Rick. So does big and bearish make sense with what you're noticing from the chart?
Well, a break below some of these levels that Don is discussing would be noteworthy here. And the levels in question are pretty similar that I had my eye on as well. First, we have this green line here, a notable low point from back late last year. Once again, was a low point during our tariff news cycle, and then it was eventually breached. However, more recently, during the past few weeks, it's held on again. So a push below 85 would be significant. 86 also stands out as well, simply because it roughly lines up with our trend line and our yellow 21-day exponential moving average. So just some pretty basic technical indicators here line up with some of these important levels here. To the flip side, if we were to break to the upside, the orange 63-day EMA lines up with a much longer-term downward sloping trend line here near the 87 level. The longer term a trend line is, the more times it's been tested, the more significant it would be if it were to be broken. If it were broken, then we have another high point here to look at near 90.30, an old high that matches up with our purple 252-day exponential moving average. And if we were to look at our volume profile and standard deviation channel studies, we can see that there's a volume node here around this area near 88. So that could be another point to keep an eye on. But if we were to look a little bit lower, if we did have a more bearish outlook here, our -1 standard deviation channel comes in just below that 82 level as well. So that would be one standard deviation down from our linear regression line, a potential place to look for support.
All right, Don, I'm going to send it back to you. Any final thoughts you want to leave us with, especially as it pertains to any risk you're watching out for with your approach with this one?
Yeah, you know what? That actually plays very nicely into the other critical risk here is going to be geopolitical. And, when it comes to geopolitical risks, there are just too many variables. But the one bottom line with the geopolitical tensions that we're seeing right now, it basically implies more spending. So more spending, again, the bond vigilantes are going to look at this. I think there's going to be some sell-side activity in the bond market. There needs to be a clear and distinct warning right now to the U.S. Treasury. The spending has got to eventually be curbed at some point.
All right, Don, let's move on to your next trade. You've got Zoom on your list, Zoom Communications. It's been underperforming the S&P 500 year to date. So is the next move big and bearish?
Yeah. So again, here's another one where, again, I am going to be bearish on Zoom. It's just this is difficult for me to wrap my arms around from a bullish perspective. Right now, as we're going to see in the chart in just a few minutes, the stock is kind of cascading lower from the 85 level down to the 80 level, possibly down to the 70 level here. Again, kind of cascading lower. But from a business perspective, what do you got right now? Everybody's talking about return to work. It's kind of ironic. It's, years later. AI is actually, in here, and it's obviously affecting the workforce to some degree. Maybe that's going to lead to, less meetings. But overall, it's really where's the new revenue stream going to come from Zoom? Everybody that's on it is likely on it right now, not exactly expansive. So they better come out with new technology or this business model could be in trouble. In the near term, I think it is in trouble. I'm going to go out to the September 19th expiration. I'm giving myself duration in this next trade because it's a fairly big one. September 19th, I'm going to be buying a 75 put, selling a 70 put. It's a $5 wide put spread done for a $1.15 debit, looking again for this cascading lower effect, take us just below the 70 level inside of Zoom between now and the September expiration.
All right, Rick, you're up. What do you notice about the chart when it comes to Zoom?
Yeah, Don makes a lot of good points. It's also not really a unique service either. There's lots of choices to do video calls, so that is another worrisome element to my mind here. But looking at the chart just specifically, we can see that it is more of a downtrend here. We had our high point here, 92.80, subsequent lower highs. A little bit of a false breakout here that followed along with our blue trend line, so a bit of hopes dashed for the bullish crowd there because we quickly retreated and we have once again encountered resistance along that very same trend line here. Our green line, 78, also marks a low point, series of low points, and then high points here after a gap down, consolidation phase, and then once again it was supportive. Now we're kind of bouncing around that level. So these are the ways that you can look for these kind of key price levels that stick out where there's a lot of stops and starts around that same area. They can be more significant here. But looking at our moving averages, they're clustering together and exhibiting a sideways slope, which speaks to declining volatility, reduced momentum here. We can see that RSI is a bit more toward the bearish side here, but approaching the 50 midline once more. So we have a bit of a confluence as well with our moving averages. To the upside, we have our 21-day and 63-day pretty close to that 78 level that I mentioned. So 78, 79, 80, that's the general resistance area that could open the way then to a push back to the upside here. 88. Highs and lows, highs once again, that could be one area to watch. But if we do move lower, 75.50 is our purple 252-day EMA, pretty close to where Don's trade would be looking for price to go below here. And, you know, we are below the point of control here on our volume profile study. We have declined below that heavy volume area. We don't really start to pick up again till down here near 75.50 once again. So another key level, that same 75 area stands out.
I feel bad for Zoom. At least I say I'm tempted to feel bad for Zoom based on your approach, Don, and then how Rick has gone through the chart. I think the Zoom executives won't be happy. But look, on a one-year basis, it has outperformed. We'll see if this approach plays out as you expect, Don. But let's talk about the final trade on your list, Intel. It's been an outperformer compared to the S&P 500 year to date. But if you look at it at 1 year, I mean, it's still, you know, on a one-year basis, still sharply lower. So what's your take here?
Yeah, that Intel chart, there's no question that it is just pure ugly after a year. The sell side activity in there has been, you can feel it, smell it, taste it pretty much. Right now, though, I think it's actually got a pretty good base of support. Here's one where I'm actually going to take a bullish stance, but I am going to give myself a little bit of duration. Look, they've been talking about restructuring for what? Months, years at this point, gone through a number of different CEOs. So the corporate restructuring is underway. We've got a bit of a chip war going on. But again, I think that they actually do have a decent basis of support, and we are going to start to see a little bit of liftoff, even if it's only temporary. That liftoff should be enough, though, to produce some degree of profitability throughout the course of this summer. So with this trade, I'm going to go out once again to the September 19th expiration, and I'm picking that duration simply to say, like, look, here in the near term, there's geopolitical risk. You got the Fed right in front of you, umpteen different announcements. But I think over the course of the summer, some of that restructuring, grips hold. If you are into PE ratios and so forth, I mean, just the breakup value of Intel is probably above where it's currently trading. So I'm going out Sep 19th expiration, buying the 22 call, selling the 26 call. So it's just a $4 wide call spread. This one is also done for a $1 debit. Some upside potential plausible in the months to come.
Okay, all right. So Rick, then your turn. Tell me what you're noticing about the chart here.
Kind of a good news, bad news type of chart if you have a bullish outlook. And what I mean by that is if we were to backtrack all the way here to where we had that very rough earnings move to the downside, we never really filled the gap at our red line here just below the 29 mark. Never even really came all that close either. From there, we've also formed a downward sloping trend line. Now, though, that was more of the bad outlook here, but here's some more interesting things that would lend to a more bullish outlook. Is that after we found these lows, look how many times we've held on to this floor at our green line here, despite some intraday fluctuations. For the most part, held on around that 1875 level. We are now seeing our moving averages once again clustering together, prices moving above them at the same time that it's moving above this shorter term downward sloping trend line, and RSI is pushing above the 50 midline. So these are things that would suggest perhaps green shoots for a bullish outlook if we were to consider some of those levels around 23, that would be the area that the bulls would want to clear to establish a potential new uptrend that's kind of a ceiling there. And then 26 would be roughly filling that gap. So those seem like some interesting points to consider for strike prices here. If we were to look another way at our charts here, we can see volume profile very low on this chart here. The heavy trading area comes in near 20. As I said before, this is often viewed as a sign that perhaps a noteworthy bottom is in. It doesn't mean it couldn't break to the downside, though. It's just saying that there's been heavy trading at these low levels here. It may signify investors hoping for a bounce.
All right. Certainly investors hoping for a bounce, and that's the approach that Don seems to be looking for, but with some duration there. That's Don Kaufman of TLT and Rick Ducat, our lead market technician. Thank you, guys.